Question 1. What is FINRA's primary role in the securities industry? A. Issuing new securities to the public. B. Regulating the U.S. monetary policy. C. Overseeing brokerage firms and their registered representatives. D. Providing deposit insurance for bank accounts. Answer: C. Overseeing brokerage firms and their registered representatives. FINRA, Financial Industry Regulatory Authority, is the largest independent regulator for all securities firms doing business in the United States, responsible for overseeing brokerage firms and their registered representatives to ensure investor protection and market integrity. It accomplishes this through rulemaking, enforcement, and arbitration. Understanding FINRA's role is crucial for anyone entering the securities industry, as it sets the standards for professional conduct and ethical practices, while the other options describe functions of investment banks, the Federal Reserve, and the FDIC, respectively. Question 2. In a joint tenancy with right of survivorship, (STRO's) account, what happens to the account assets upon the death of one account holder? A. The deceased's share passes to their estate. B. The surviving account holder, S, automatically inherit the deceased's share. C. The account is frozen until probate is completed. D. The assets are liquidated and distributed equally among all heirs. Answer: B. The surviving account holder, S, automatically inherit the deceased's share. In a STRO's account, assets bypass probate and automatically transfer directly to the surviving account holder, S, upon the death of one owner. This arrangement ensures a smooth and immediate transfer of ownership, which is a key advantage for individuals who wish for their jointly held assets to go directly to the co-owner without the delays and costs associated with probate. This contrasts with tenancy in common, TIC, where the deceased's share would pass to their estate according to their will. Question 3. Which of the following activities occurs exclusively in the primary market? A. An investor selling shares of Apple stock on the NYSE. B. A company conducting an initial public offering, IPO. C. A mutual fund trading bonds with another institutional investor. D. A retail investor buying a previously issued corporate bond from a broker-dealer. Answer: B. A company conducting an initial public offering, IPO. The primary market is where new securities are sold to the public for the first time, directly from the issuer to investors, to raise capital. An initial public offering, IPO, is the quintessential example of a primary market transaction, as a company issues brand new shares. All other options describe transactions involving securities that have already been issued and are trading among investors, which are characteristic of the secondary market. Question 4. Which of the following securities is generally exempt from the registration requirements of the Securities Act of 1933? A. Corporate common stock. B. Municipal bonds. C. Options contracts. D. American Depositary Receipts, ADRs. Answer: B. Municipal bonds. The Securities Act of 1933 requires most securities offered to the public to be registered with the SEC, ensuring full and fair disclosure through a prospectus. However, certain securities are exempt from these registration requirements, notably municipal bonds, U.S. government securities, and commercial paper, primarily due to the perceived safety or nature of their issuers. Understanding these exemptions is critical for identifying which offerings require detailed prospectuses and which do not. Question 5. A mutual fund is characterized by which of the following features? A. Shares trade on exchanges throughout the day at market-determined prices. B. It is a fixed portfolio of securities that does not actively trade. C. Shares are typically redeemed directly with the fund at net asset value, NAV, at the end of the trading day. D. It issues a fixed number of shares that are traded among investors. Answer, C. Shares are typically redeemed directly with the fund at net asset value, NAV, at the end of the trading day. Mutual funds, also known as open-end investment companies, continuously issue and redeem shares, meaning their capital base is not fixed. Investors purchase shares directly from the fund or its distributors, and when they want to sell, they redeem their shares with the fund at the current net asset value, NAV. The NAV is calculated once daily at the close of trading, ensuring all transactions for that day occur at the same price. This structure differs significantly from closed-end funds and exchange-traded funds, ETFs, whose shares trade on exchanges at market-determined prices throughout the day. Question 6. When a firm acts as a broker in a securities transaction, it is performing which of the following functions? A. Buying securities into its own inventory to resell to customers. B. Facilitating a transaction between a buyer and a seller, charging a commission. C. Selling securities from its own inventory to a customer. D. Taking a principal position in the trade, buying from one customer and selling to another from inventory. Answer, B. Facilitating a transaction between a buyer and a seller, charging a commission. A firm acts as a broker when it executes trades on behalf of customers, connecting buyers and sellers without taking ownership of the securities themselves, operating in an agency capacity. For this service, the firm charges a commission. Conversely, when a firm acts as a dealer, it trades from its own inventory, taking a principal position, buying at its bid price and selling at its ask price, earning a markup or markdown, which represents the firm's profit. Understanding this distinction is fundamental to identifying a firm's role and how it is compensated in a transaction. Question 7. Under Regulation T, what is the initial margin requirement for purchasing common stock in a margin account? A. 75% of the purchase price. B. 25% of the purchase price. C. 50% of the purchase price. D. 100% of the purchase price. Answer, C. 50% of the purchase price. Regulation T, set by the Federal Reserve Board, governs the extension of credit by broker-dealers to customers for the purchase of securities. For the initial purchase of common stock in a margin account, Regulation T typically requires customers to deposit at least 50% of the purchase price, with the broker-dealer lending the remaining amount. This requirement helps to limit excessive speculation and leverage in the market, protecting both investors and the financial system. It's crucial for understanding the mechanics of margin accounts. Question 8. Which of the following characteristics best describes a Treasury bill, T-bill? A. Long-term, interest-bearing bond issued at par. B. Short-term, discount security issued by the U.S. government. C. Medium-term, fixed-rate note issued by a corporation. D. Long-term, zero-coupon bond issued by a municipality. Answer, B. Short-term, discount security issued by the U.S. government. Treasury bills, T-bills, are short-term debt instruments issued by the U.S. government with maturities of 1 year or less, e.g., 4, 8, 13, 17, 26, 52 weeks. They are unique among Treasury securities in that they are issued at a discount to their par value and do not pay periodic interest. The investor's return comes from the difference between the discounted purchase price and the par value received at maturity. T-bills are considered one of the safest investments due to the backing of the U.S. government's full faith and credit. Question 9. An investor who buys a call option is expecting which of the following market movements for the underlying security? A. A significant decrease in price. B. A stable price with low volatility. C. A significant increase in price. D. A moderate decrease in price. Answer, C. A significant increase in price. Buying a call option grants the holder the right, but not the obligation, to purchase the underlying asset at a specified strike price on or before a certain expiration date. Investors typically buy call options when they anticipate a significant increase in the price of the underlying security, as this would make exercising the option profitable. This strategy offers leverage, allowing for potential gains from a price rise with a limited risk, the premium P/D, if the price falls, making it a common bullish strategy. Question 10. What is the primary source of repayment for general obligation, GO, municipal bonds? A. Revenues generated by a specific project, such as a toll road. B. Lease payments from a corporation. C. The full faith and credit of the issuing municipality, backed by its taxing power. D. Profits from a public utility company. Answer, C. The full faith and credit of the issuing municipality, backed by its taxing power. General obligation, GO, municipal bonds are secured by the full faith and credit of the issuing municipality and are repaid from the issuer's general tax revenues, such as property taxes or sales taxes. These bonds typically require voter approval, as they represent a direct obligation against the issuer's general fund. This contrasts with revenue bonds, which are repaid solely from the income generated by the specific project they finance, highlighting a key difference in their risk profiles and repayment mechanisms. Question 11. In a firm commitment underwriting, who bears the financial risk if the entire issue of securities cannot be sold to the public? A. The issuing corporation. B. The syndicate of underwriters. C. Individual retail investors. D. The Securities and Exchange Commission, SAC. Answer, B. The syndicate of underwriters. In a firm commitment underwriting, the syndicate of underwriters agrees to purchase the entire issue of securities from the issuer and then resell them to the public. Under this arrangement, the underwriters assume the full financial risk of any unsold shares, as they are obligated to pay the issuer for the entire offering regardless of their success in reselling. This contrasts with a best efforts underwriting, where the issuer retains the risk, making the commitment type a critical factor in risk allocation during an offering. Question 12. A registered representative must have a reasonable basis to believe a recommendation is suitable for a customer. Which of the following factors is least important in determining suitability? A. The customer's financial situation and needs. B. The customer's investment objectives and risk tolerance. C. The customer's name and address. D. The customer's age and investment experience. Answer, C. The customer's name and address. Suitability obligations require registered representatives to recommend investments that are appropriate for a customer's specific financial situation, investment objectives, and risk tolerance. While a customer's name and address are necessary for account opening and record keeping, they are generally not directly relevant to determining the suitability of a particular investment product or strategy. Factors like financial situation, investment objectives, risk tolerance, age, and experience are crucial for making appropriate, ethical, and compliant recommendations. Question 13. If interest rates in the market rise, what is the likely immediate effect on the market price of existing bonds? A. Bond prices will increase. B. Bond prices will decrease. C. Bond prices will remain unchanged. D. Bond prices will fluctuate unpredictably. Answer, B. Bond prices will decrease. Bond prices and interest rates have an inverse relationship. When prevailing interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower coupon rates less attractive to investors. To compensate for their lower yield, the market price of existing bonds must fall, making their yield to maturity competitive with new issues. This fundamental principle is crucial for understanding bond market dynamics and potential capital gains or losses for bondholders. Question 14. What is a key distinction between an open-end management company, mutual fund D, and a closed-end management company? A. Open-end funds trade on exchanges, while closed-end funds do not. B. Open-end funds issue a fixed number of shares, while closed-end funds continuously issue shares. C. Open-end funds are redeemed at NAV, while closed-end funds trade at market price. D. Open-end funds primarily invest in stocks, while closed-end funds primarily invest in bonds. Answer: C. Open-end funds are redeemed at NAV, while closed-end funds trade at market price. The primary distinction between open-end, mutual funds, and closed-end funds lies in how their shares are traded and priced. Open-end funds continuously issue and redeem shares directly with the fund at their net asset value, NAV, calculated once daily. Closed-end funds, however, issue a fixed number of shares that trade on stock exchanges like regular equities, meaning their market price can be above, at a premium to, or below, at a discount to, their NAV, depending on supply and demand in the secondary market. This difference affects liquidity and pricing mechanisms for investors. Question 15. The Securities Act of 1933 is primarily concerned with regulating which aspect of the securities industry? A. Trading activities in the secondary market. B. The offering and sale of new securities. C. The operation of broker-dealers and exchanges. D. Insider trading and market manipulation. Answer: B. The offering and sale of new securities. The Securities Act of 1933 is often referred to as the Truth in Securities Law and focuses on requiring full and fair disclosure in connection with the offering and sale of new securities to the public. Its main objective is to ensure investors receive essential information about new issues so they can make informed investment decisions, primarily through the registration statement and prospectus. Secondary market activities are generally covered by the Securities Exchange Act of 1934, and insider trading by various provisions of both acts. Question 16. In a cash account, a customer is required to pay for securities purchases in full by which settlement date? A. T+1, trade date plus 1 business day. B. T+2, trade date plus 2 business days. C. T+4, trade date plus 4 business days. D. T+0, on the trade date. Answer: B. T+2, trade date plus 2 business days. For most equity and corporate bond transactions in a cash account, payment in full must be made by the regular way settlement date, which is T+2, trade date plus 2 business days. This means the buyer must have funds available and the seller must deliver securities within this timeframe to ensure the transaction is completed efficiently. Understanding settlement dates is crucial for managing customer accounts and ensuring timely completion of trades, especially when dealing with Regulation T requirements. Question 17. Which type of risk affects the entire market or a large segment of it and cannot be mitigated through diversification? A. Business risk. B. Financial risk. C. Systematic risk. D. Unsystematic risk. Answer: C. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk inherent to the entire market or a broad market segment. It is caused by macroeconomic factors such as interest rate changes, inflation, geopolitical events, or recessions, and cannot be eliminated through diversification because it impacts all investments to some degree. Unsystematic risk, conversely, is company-specific risk that can be reduced or eliminated through proper diversification across different companies and industries, making it crucial to distinguish between the two for portfolio management. Question 18. All of the following are typically characteristics of preferred stock except A. Fixed dividend payments. B. Priority over common stock in liquidation. C. Voting rights. D. No maturity date. Answer: C. Voting rights. Preferred stock typically offers a fixed dividend payment and has priority over common stockholders in the event of a company's liquidation, meaning they get paid before common shareholders. Like common stock, it generally has no maturity date. However, a key difference is that preferred stock usually does not carry voting rights, which are reserved for common shareholders. This lack of voting power is often a trade-off for the security of a fixed dividend and liquidation preference. Question 19. An American Depositary Receipt, ADR, represents ownership in what? A. U.S. company's shares held by a foreign bank. B. A foreign company's shares held by a U.S. bank. C. U.S. government bonds. D. A basket of U.S. and foreign currencies. Answer: B. A foreign company's shares held by a U.S. bank. American Depositary Receipts, ADRs, are certificates issued by a U.S. bank that represent a specified number of shares of a foreign company's stock, which are held in trust by the U.S. bank. They allow U.S. investors to buy and sell shares of foreign companies on U.S. exchanges, providing a convenient and relatively simple way to invest in international equities without having to trade in foreign markets directly. ADRs simplify currency conversions and dividend distributions for the U.S. investor. Question 20. Who owes a fiduciary duty to the beneficiaries of an account? A. A broker acting on an unsolicited order. B. A registered representative making a suitable recommendation. C. An investment advisor providing advice for a fee. D. A principal approving a new account. Answer: C. An investment advisor providing advice for a fee. An investment advisor, when providing advice for a fee, typically owes a fiduciary duty to their clients under the Investment Advisors Act of 1940. This means they must act in their clients' best interests and disclose any potential conflicts of interest, holding themselves to the highest standard of care. While broker-dealers and registered representatives also have suitability obligations and ethical duties, the strict fiduciary standard generally applies specifically to investment advisors. Understanding this distinction is crucial for investor protection and regulatory compliance. Question 21. A bond with a call provision is most likely to be called by the issuer when A. Interest rates have risen significantly since the bond was issued. B. Interest rates have fallen significantly since the bond was issued. C. The issuer's credit rating has deteriorated. D. The bond's market price has fallen below par. Answer: B. Interest rates have fallen significantly since the bond was issued. A call provision allows the issuer to redeem the bond before its maturity date, typically at a predetermined call price. Issuers are most likely to exercise this option when prevailing interest rates have fallen significantly since the bond was issued. This enables them to refinance their debt at a lower cost, similar to how a homeowner might refinance a mortgage. This feature introduces reinvestment risk for the bondholder, as they may have to reinvest their principal at a lower interest rate. Question 22. Which of the following describes an exchange-traded note, ETN? A. A type of mutual fund that trades on an exchange. B. An unsecured debt instrument linked to the performance of an underlying index. C. A fixed portfolio of bonds that trades actively. D. An actively managed fund designed to outperform a specific benchmark. Answer, B. An unsecured debt instrument linked to the performance of an underlying index. An exchange-traded note, ETN, is an unsecured debt instrument that typically tracks an underlying market index, rather than holding physical assets. Unlike ETFs, ETNs are promises from the issuer, usually a financial institution, to pay the return of the index, minus fees, at maturity, or at the investor's election to redeem. This exposes investors to the credit risk of the issuer, in addition to market risk, making it an important consideration when evaluating these products. Question 23. Interest income from municipal bonds is generally exempt from federal income tax. Under what circumstances might it also be exempt from state and local taxes? A. Always, regardless of where the investor resides. B. Only if the bonds are issued by a U.S. territory. C. If the investor resides in the state or municipality that issued the bonds. D. Never, municipal bond interest is only federal tax exempt. Answer, C. If the investor resides in the state or municipality that issued the bonds. While interest income from municipal bonds is generally exempt from federal income tax, it may also be exempt from state and local income taxes if the investor is a resident of the state or municipality that issued the bonds. This is commonly known as the double tax exemption, or triple tax exemption, if local taxes also apply. This tax advantage makes municipal bonds particularly attractive to high-income investors, especially those residing in high-tax states, seeking to maximize their after-tax yield. Question 24. An investor who buys a put option is hoping for which of the following price movements in the underlying stock? A. The stock price to remain stable. B. The stock price to increase significantly. C. The stock price to decrease significantly. D. The stock price to increase moderately. Answer, C. The stock price to decrease significantly. Buying a put option grants the holder the right, but not the obligation, to sell the underlying asset at a specified strike price on or before a certain expiration date. This strategy is primarily employed by investors who anticipate a significant decline in the price of the underlying security, allowing them to profit from a downward movement or to protect a long position against a potential price drop. The maximum loss for the put buyer is limited to the premium paid, making it a defined risk bearish strategy. Question 25. A maintenance margin call is issued when the equity in a customer's margin account falls below which threshold? A. The initial margin requirement. B. The Regulation T requirement. C. The broker-dealer's minimum maintenance requirement. D. The loan value of the securities. Answer, C. The broker-dealer's minimum maintenance requirement. A maintenance margin call occurs when the equity in a customer's margin account drops below the broker-dealer's minimum maintenance requirement, which is typically 25% of the market value of the securities, as mandated by FINRA. This differs from the initial margin call, which relates to the Regulation T requirement, typically 50%, at the time of purchase. The purpose of a maintenance margin is to ensure the customer maintains sufficient equity to cover potential losses and protect the broker-dealer's loan, thereby managing risk for both parties. Question 26. State securities laws are commonly referred to as A. Securities Acts of 1933 and 1934. B. Blue sky laws. C. FINRA rules of fair practice. D. Uniform Commercial Code. Answer, B. Blue sky laws. State securities laws are commonly known as blue sky laws, a term that originated from a judge's comment about promoters selling parcels of the blue sky to gullible investors. These laws require the registration of securities, broker-dealers, and agents at the state level, in addition to federal regulations, meaning issuers and individuals must comply with both state and federal requirements. Their primary aim is to protect investors from fraudulent practices and ensure fair dealings within their respective states. Question 27. A bond rated BBB by S&P is considered A. High yield or junk bond. B. Investment grade bond. C. Speculative bond. D. Below investment grade. Answer, B. Investment grade bond. Bond ratings from agencies like S&P and Moody's assess the creditworthiness of an issuer and the likelihood of timely principal and interest payments. Bonds rated BBB or higher by S&P, or Ba3 or higher by Moody's, are generally considered investment grade, meaning they are judged to have a relatively low risk of default and are suitable for institutional investors. Ratings below this threshold are considered speculative or junk bonds, carrying higher credit risk and often requiring higher yields to attract investors. Understanding these ratings is crucial for assessing bond risk. Question 28. What type of order is executed immediately at the best available price? A. Limit order. B. Stop order. C. Market order. D. Stop limit order. Answer, C. Market order. A market order is an instruction to buy or sell a security immediately at the best current price available in the market. It prioritizes execution over price, meaning it is guaranteed to be filled, but the exact price may not be known until the order is executed, especially in volatile markets. This contrasts with limit orders, which specify a maximum buying price or a minimum selling price, guaranteeing the price but not necessarily the execution. Understanding order types is fundamental for trade execution. Question 29. For most individual investors, long-term capital gains are typically taxed at what rate compared to ordinary income? A. The same rate as ordinary income. B. A higher rate than ordinary income. C. A lower rate than ordinary income. D. Capital gains are always tax-exempt. Answer, C. A lower rate than ordinary income. For most individual investors, long-term capital gains, profits from assets held for more than 1 year, are typically taxed at preferential, lower rates than ordinary income. This tax treatment is designed to encourage long-term investing by providing a tax incentive for holding assets for extended periods. Short-term capital gains, however, are generally taxed at the investor's ordinary income tax rate, which can be significantly higher. This distinction is critical for tax planning in investing. Question 30. What is a dark pool in the context of securities trading? A. An exchange where only thinly traded stocks are listed. B. A private forum for institutional investors to trade large blocks of securities anonymously. C. A regulated market for trading high-risk penny stocks. D. A public exchange for trading options contracts. Answer, B. A private forum for institutional investors to trade large blocks of securities anonymously. Dark pools are private trading platforms, typically operated by large institutional investors or broker-dealers, that allow institutional investors to trade large blocks of securities anonymously. Their primary purpose is to allow large trades to be executed without publicly displaying the order, which helps to prevent market impact and adverse price movements that might occur if the order was visible on a public exchange. While offering anonymity, they also raise concerns about transparency and fairness for retail investors. Question 31. What is the primary function of the Depository Trust and Clearing Corporation, DTC? A. To provide investment advice to retail customers. B. To facilitate the clearance and settlement of securities transactions. C. To underwrite new issues of corporate bonds. D. To regulate the activities of hedge funds. Answer, B. To facilitate the clearance and settlement of securities transactions. The Depository Trust and Clearing Corporation, DTC, is a critical piece of market infrastructure, primarily responsible for the clearance and settlement of transactions for virtually all U.S. securities. Through its subsidiaries, like the National Securities Clearing Corporation, NSC, and the Depository Trust Company, DTC, it automates, centralizes, and standardizes post-trade processing. This significantly reduces risk and improves efficiency in the financial markets by ensuring that securities and funds are exchanged smoothly and reliably between parties, preventing systemic failures. Question 32. Which of the following statements is true regarding real estate investment trusts, REITs? A. REITs typically avoid distributing most of their income to shareholders to reinvest for growth. B. REITs are generally exempt from corporate income tax if they distribute at least 90% of their taxable income to shareholders. C. REITs directly invest in mortgages but not in physical real estate. D. REITs offer direct ownership of real estate properties to investors. Answer, B. REITs are generally exempt from corporate income tax if they distribute at least 90% of their taxable income to shareholders. Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate. A key characteristic is that if a REIT distributes at least 90% of its taxable income to its shareholders, it can avoid corporate income tax at the corporate level, although the distributed income is taxable to the shareholders. REITs offer investors an accessible, liquid way to invest in real estate, but they do not offer direct ownership of the underlying properties. Some REITs invest in mortgages, mortgage REITs, while others invest in physical properties, equity REITs. Question 33. If a customer fails to meet a Regulation T margin call, what is the broker-dealer typically required to do? A. Allow the customer an unlimited extension to pay. B. Request a 30-day extension from FINRA. C. Liquidate the necessary securities in the account. D. Transfer the debt to a collection agency. Answer, C. Liquidate the necessary securities in the account. If a customer fails to meet a Regulation T margin call, usually payment for a purchase in a margin account, within the specified timeframe, T+4, or 2 business days after regular way settlement T+2, the broker-dealer is generally required to liquidate enough securities in the account to satisfy the call. While extensions can sometimes be requested from the designated examining authority, DEA, liquidation is the standard action to mitigate risk if the call is not met promptly. This rule is crucial for maintaining proper credit risk management in margin accounts. Question 34. An investor holding shares of a U.S. company that primarily exports goods to Europe would be most concerned about which of the following risks if the U.S. dollar strengthens significantly against the euro? A. Interest rate risk. B. Reinvestment risk. C. Currency risk. D. Liquidity risk. Answer, C. Currency risk. Currency risk, also known as exchange rate risk, is the risk that the value of an investment denominated in a foreign currency, or the earnings of a company exposed to foreign currencies, will fluctuate due to changes in exchange rates. If the U.S. dollar strengthens against the euro, European customers find U.S. exports more expensive in their local currency, potentially reducing sales and profits for the U.S. company. This ultimately negatively impacts the U.S. company's share price and thus the U.S. investor, highlighting the importance of understanding global economic factors. Question 35. For a mutual fund, the net asset value, NAV, per share is calculated by A. Dividing the fund's total assets by the number of shares outstanding. B. Dividing the fund's total assets minus its liabilities by the number of shares outstanding. C. Taking the fund's total assets and subtracting expenses. D. Multiplying the fund's total assets by the number of shares outstanding. Answer, B. Dividing the fund's total assets minus its liabilities by the number of shares outstanding. The net asset value, NAV, per share for a mutual fund is calculated by taking the fund's total assets, subtracting its total liabilities, and then dividing that result by the number of outstanding shares. This calculation is performed once daily, typically at the close of the market, and represents the per share value at which investors can buy or redeem mutual fund shares. NAV is a fundamental metric for understanding a mutual fund's intrinsic value and is the price at which fund shares are transacted.